Tomorrow morning, one man is going to stand in front of a microphone in the mountains of Wyoming, and by the time he sits back down, gold could be $100 richer or $100 poorer than it is right now. Before I explain why, I want to ask you something. If you owned gold today, would you know right now what would make you sell it? Not someday, tomorrow at 10 in the morning Eastern Time. Most people who hold gold have never actually answered that question for themselves. By the end of this video, you will have a real framework for answering it, because Friday is going to test every gold holder's patience, whether they realize it or not. Here's the strange part almost nobody talks about. There is no Federal Reserve meeting scheduled this month. Not this week, not next week. If you've been waiting for a rate decision to move gold in August, you are waiting for something that was never on the calendar. The next actual vote on interest rates doesn't happen until the middle of September. And yet, every trading desk on Earth is bracing for Friday morning like it's a rate decision anyway. That should tell you something about how much power one speech can carry when the right person is standing behind the podium. So let's start with the place itself, because the setting actually matters here. Jackson Lake Lodge sits in northwestern Wyoming, with the Grand Teton Range rising up behind it and the Snake River running along the front. It looks more like a postcard than a policy venue. Since 1978, the Federal Reserve Bank of Kansas City has used this lodge to host an economic symposium every August, and for most of its history, it stayed exactly what it sounds like, a quiet academic retreat for central bankers, professors, and finance ministers from around the world, important people talking mostly to each other, mostly out of public view. Then, over time, it stopped being quiet. Fed chairs figured out that this stage, away from the formal language of an official policy statement, gave them room to say things more plainly than they ever could in a press release negotiated line by line with the rest of the committee. And once markets figured that out too, Jackson Hole stopped being background noise. It became an event. You don't have to take that on faith. There's a track record. In August 2010, Ben Bernanke used this same podium to signal that the Fed was preparing to pump more money into the financial system through what became known as the second round of quantitative easing. Gold moved meaningfully higher in the months that followed because when a central bank signals it's about to create more currency, the currency already in circulation tends to lose some purchasing power, and gold tends to benefit from that. Then, in August of 2022, Jerome Powell walked up to that same podium and gave one of the shortest, bluntest speeches in the event's history, just 8 minutes, warning that inflation was public enemy number one and that the fight against it would cause real pain for American households. Gold fell hard in the days that followed. Same location, same audience, completely opposite outcome, because what mattered wasn't the venue. It was what the man standing there chose to say. That brings us to this Friday, and to a Fed chair the market genuinely does not know how to read yet. But this is where the story gets more interesting, because the man speaking this year isn't just new to the job. He's operating by a different rulebook entirely, and that difference is the whole reason this speech carries so much weight. Kevin Warsh is not a stranger to moments like this. He served as a Federal Reserve governor from 2006 to 2011, which means he was inside the building during the 2008 financial crisis, sitting at the table while decisions were being made in real time that most of us only read about years later in retrospective books. He left the Fed, spent over a decade in the private sector and in academic and policy circles, and then returned this year, sworn in as Federal Reserve Chair on May 22nd, in one of the narrowest Senate confirmations for that position in the country's history. He has now been in the chair for a little over 3 months, and in that short window, he's made one thing unmistakably clear. He's not going to run the Fed the way his predecessor did. Jerome Powell's approach had a name inside financial circles: forward guidance. The idea was simple. Tell markets what's likely coming well before it happens. Let expectations adjust gradually. By the time the actual decision arrives, nobody's surprised. It was designed to keep markets calm through predictability. Warsh has more or less rejected that approach outright. At his press conference following the Fed's July meeting, he pushed back directly on the idea that the committee was simply pausing and waiting, telling reporters the Fed intended to act based on incoming data rather than on what markets had already priced in. He has since gone further, restructuring how the Fed even writes its post-meeting statements, stripping out the kind of forward-looking language that used to fill them, and openly voicing skepticism about the entire concept of guiding markets in advance. In practice, that means when Warsh speaks, nobody, not the big banks, not the hedge funds, not the algorithms, can say with real confidence what he's about to say. That uncertainty itself is valuable information, and it's exactly the kind of thing that moves prices fast once it resolves. Now, before we get into what he might actually say Friday, you need a clear picture of where gold and silver stand today, because the starting point shapes how far any reaction could realistically travel in either direction. As of this week, gold has been trading in the neighborhood of $4,600 an ounce, having briefly touched a more than 3-month high near $4,700 before losing some of that momentum. Its all-time record, just above $5,600, was set back in late January of this year. In the months after that peak, gold gave back a significant chunk of its gains, pulled down by a mix of rate hike anxiety, heavy profit-taking after an extraordinary run, and geopolitical tension that eased and then flared again. At its lowest point in early August, gold had drifted down toward the $4,000 level, a meaningful pullback from the January high. Then, a handful of economic reports landed close together and changed the picture. July's jobs numbers came in weaker than economists expected. Inflation readings, both the consumer-facing measure and the one that tracks what businesses pay for raw materials, came in softer than feared. Together, those reports pulled the market's expectation for a September rate hike down from roughly even odds to somewhere in the high 30s%. Gold responded by climbing sharply through August, one of its strongest single-month moves in years. Silver has been telling a similar story, trading in the high 60s per ounce, up sharply for the month and up dramatically over the past year, one of the standout performers among major commodities in 2026. Silver's all-time high, also set in late January, sits above $120. Here's the part worth sitting with for a moment. Almost all of gold's recovery through August rests on a single assumption, that the Fed holds rates steady in September rather than raising them. Friday is the first real test of whether that assumption survives contact with an actual Fed chair speaking in public. To understand why a single speech can shift that assumption so quickly, you need to understand a concept that most financial coverage glosses right over, something called the real yield. Let me build it from the ground up, because once you understand this, everything else about Friday will make much more sense. Imagine you have two choices for where to put your money. Option 1, you lend it to the United States government by buying a Treasury bond, and in return you collect interest, currently somewhere around 4 to 4.5% a year. Option 2, you buy gold. Gold pays you nothing. No interest, no dividend, nothing but the hope that its price goes up. So why would any rational investor choose the option that pays zero? Here's the answer. Inflation, measured by the Fed's preferred gauge, has been running close to 3.5% to 4% a year recently. If your Treasury bond pays you 4% and inflation is eating away roughly the same amount, your actual gain in real purchasing power is close to nothing. That tiny gap, the bond's stated interest rate minus inflation, is called the real yield. When that gap shrinks, holding gold barely costs you anything in lost income because the bond wasn't really making you money after inflation anyway. When that gap turns negative, when inflation runs faster than what bonds pay, gold stops being a sacrifice and starts being the more rational choice. This is the entire mechanism connecting a speech in Wyoming to a price on a screen. When real yield expectations fall, when the market thinks inflation is running hot or rate hikes are unlikely, the appeal of gold rises and buyers step in. When real yield expectations rise, some of that money flows back toward bonds instead. Every sentence Warsh says on Friday nudges those expectations one way or the other, and gold responds almost immediately. Now, hold on to one more number, because we're going to come back to it later, and it matters more than almost anything else in this conversation. That number is 40 trillion. To understand what Warsh is walking into Friday, you also need to understand what happened at the Fed's last meeting on July 29th and what's happened since. The committee voted to hold interest rates steady for a fifth consecutive meeting this year, keeping the target range at 3.5% to 3.75%. On the surface, a hold sounds uneventful, but the vote itself was 9-3. 3 regional Fed presidents, Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan, all voted against the hold in favor of raising rates. 3 simultaneous dissents from officials, all pushing in the same direction, hadn't happened since 2016, and it signals that the argument over what to do next inside the Fed is very much alive, not settled. Warsh himself described the internal debate as a good family fight, a phrase that's been repeated across financial media ever since, and he seems to be framing that division as healthy disagreement rather than institutional dysfunction. Layer today's economic data on top of that. The Fed's preferred inflation measure has been running close to 3.5% to 4% year over year, still comfortably above the Fed's 2% target. Growth has been modest, but not weak enough to make further rate hikes look unnecessary. Put it together, and you get inflation still running hot. 3 sitting Fed officials openly pushing for a hike. A chair who has explicitly said he won't manage market expectations in advance. And a high-profile speech arriving in the middle of all of it. That's the room Kevin Warsh is walking into Friday morning. Let's walk through what could realistically happen, because there isn't just one outcome here, there are several, and each one carries a different price range attached to it. The first possibility is that Warsh leans hawkish, using central bank language that favors higher rates to fight inflation. If that happens, you'd likely hear him describe inflation as persistent rather than fading, frame the Fed as prepared to act if incoming data demands it, and decline to rule out a September hike. He might even offer some quiet acknowledgement that the 3 dissenting officials from July had a reasonable case. What he almost certainly would not do is offer the kind of reassurance that would take a September hike off the table. If that's the tone Friday, here's roughly how markets could respond. The dollar tends to strengthen when investors believe U.S. rates are heading higher, because a higher yielding dollar becomes more attractive to hold relative to other currencies. And because gold is priced in dollars, a stronger dollar makes gold more expensive for buyers everywhere else in the world, in Tokyo and Frankfurt, across the Middle East, even though the dollar price of gold hasn't technically moved yet. That alone can dampen international demand. At the same time, Treasury yields typically climb as the market prices in higher hike odds, which pushes real yields up and makes gold comparatively less attractive to hold instead of bonds. In a genuinely hawkish scenario, some analysts believe gold could pull back somewhere in the range of $80 to $150 within the first few hours of trading, potentially testing levels closer to $4,400, with September hike odds jumping back above 50%. Silver, which tends to move more sharply than gold in both directions because its market is smaller and thinner, could see a comparable pullback toward the low 60s. But here's what a hawkish speech would not do. It would not undo the structural reasons gold has climbed as far as it has over the past couple of years, reasons like record central bank buying, long-running concerns about dollar debasement, and a global shift among reserve managers toward diversifying away from the dollar. None of that changes because of 20 minutes of remarks in Wyoming. A hawkish speech could create real short-term pain. For some investors who've been waiting on the sidelines, that kind of pullback might even look like the entry point they've been hoping for. Short-term pain and a broken long-term case are two very different things, and mixing them up is one of the more expensive mistakes an investor can make around an event like this. The second possibility is that Warsh gives a genuinely neutral speech, one that doesn't meaningfully shift September expectations in either direction. This is currently the scenario most of Wall Street seems to be positioned for. A neutral address might spend real time on the conference's actual theme this year, which happens to be financial innovation, meaning digital payments, the future of the dollar, and how fintech is reshaping the plumbing of the financial system while offering little or nothing new on the near-term rate path. He might acknowledge inflation as an ongoing concern without validating or dismissing the 3 dissenters, and without saying anything that changes the current numbers. If that's what happens, gold's immediate reaction would likely be fairly flat, holding somewhere close to its current range in the hours after the speech wraps up. The dollar and Treasury yields would probably stay fairly stable too. Silver would likely hold its ground, supported by steady industrial demand from solar panels, electric vehicles, and electronics. Demand that doesn't really care what a Fed chair says in Wyoming. Here's the part worth pausing on, though, because a neutral outcome is not actually a neutral event for markets. If neutral is already what everyone expects, then confirming it delivers no reward, because markets don't pay you for the outcome they already priced in. All the real risk sits in the surprise direction. If even one sentence in that speech reads as more hawkish than expected, some phrase about inflation proving stickier than hoped, the market's reaction could be outsized precisely because everyone was positioned for calm. Picture a room where everyone's holding their breath, waiting for nothing to happen. The quieter the room, the louder any unexpected noise sounds. Before we get to the third scenario, I want to pause here for a second, because if you've made it this far, you clearly care about actually understanding markets rather than just reacting to headlines, and that's exactly the kind of viewer this channel is built for. If that sounds like you, consider subscribing, because we're going to be covering both Friday's reaction and the full breakdown of the September Fed meeting when it arrives, and you'll want to be here for both. Now, the third possibility, and this is the one the market currently assigns the lowest odds to. Warsh could lean dovish, signaling patience, communicating that the Fed isn't in a hurry to move, and suggesting September isn't really a live hiking decision under the current data. You might hear him describe inflation as trending in the right direction, even with recent readings coming in slightly above forecast, or reference the added uncertainty from ongoing tensions in the Middle East, pushing energy prices higher in ways that may not reflect lasting inflation pressure. You might hear language emphasizing that current policy already gives the Fed room to wait and watch before acting further. What you likely would not hear is the word hike appear anywhere in the remarks. The real signal to watch for is whether Warsh raises the bar for what it would actually take to justify a September move. If he frames a hike as something that would require meaningfully worse data than what currently exists, markets are likely to read that as dovish, regardless of how measured the rest of his language sounds, simply because it pushes the market's current 38% hike probability lower. If that scenario plays out, the dollar would likely weaken, making gold comparatively cheaper for international buyers. Treasury yields would likely fall, compressing real yields further and making gold more attractive relative to bonds. Investors who've been sitting on the sidelines waiting for clarity could move back in quickly, and historically, Moves like that tend to happen fast rather than gradually, because a lot of capital tends to shift in the same direction at once. In a genuinely dovish scenario, some analysts see gold potentially pushing toward the $4,700 to $4,800 range within a day or two, with September hike odds falling well below current levels. Silver, given its tendency to amplify gold's upside moves, could push into the low to mid 70s. This scenario carries the lowest assigned probability right now, but low probability doesn't mean low impact. When markets have collectively positioned for one outcome and a different one shows up instead, the repricing tends to be sharper than the odds alone would suggest, because a lot of positioning has to unwind all at once in the same direction at the same time. So now let's come back to that number I asked you to hold on to earlier, $40 trillion. That's roughly where the total federal debt of the United States now stands, having crossed the $39 trillion mark earlier this year and continued climbing since. In the first 7 months of this fiscal year alone, the government paid around $628 billion in net interest on that debt. Just the interest, not a single dollar of it, going toward paying down what's actually owed. For comparison, Medicare, the federal health insurance program covering more than 60 million elderly and disabled Americans, cost the government roughly $588 billion over that same stretch. For the first time in the country's history, interest payments on the national debt now exceed what the government spends, keeping some of its most vulnerable citizens covered. Here's why that number connects so directly back to gold. Every time the Fed raises rates, even by the smallest standard increment of 1/4 percentage point, the cost of servicing that debt climbs with it, not by a trivial amount, but by billions of dollars a year, compounding as existing debt matures and gets refinanced at higher rates. There's a real, if unspoken, ceiling on how far any Fed chair can push rates, before the consequences stop being primarily about fighting inflation and start becoming a question of whether the federal government can comfortably keep servicing its own obligations. Nobody in Washington says that out loud, but the arithmetic is visible to anyone willing to look at it. That arithmetic may be part of why the world's central banks bought a net 288.9 tons of gold in the second quarter of this year alone, a 62% jump from the same quarter a year earlier, and the strongest second quarter total in the World Gold Council's entire recorded data series. Poland led the buying, followed closely by China, with a handful of smaller economies adding meaningfully to their reserves as well. These are not short-term traders reacting to a speech. These are institutions making long, deliberate decisions about where to hold national wealth, decisions made against the backdrop of a debt load north of $40 trillion and interest payments, now outpacing entire federal programs. They appear to have concluded, quietly, through months of sustained buying rather than any single dramatic announcement, that they want more of their reserves parked somewhere that doesn't depend entirely on any single government's ability to manage its own balance sheet. That's the floor underneath gold that no 20-minute speech reaches. Not a technical support level on a chart, but the underlying math of a growing debt burden and the response that math is quietly producing from institutions with the most to lose if they get this wrong. Even in a scenario where Warsh sounds hawkish Friday and gold pulls back sharply, that structural floor doesn't move. What changes is the short-term price. What doesn't change is the reason that floor exists in the first place. So let's bring this together. Tomorrow, Friday, August 28th, Kevin Warsh delivers his first Jackson Hole address as Federal Reserve Chair, a man who has been explicit about refusing to signal his moves in advance, working alongside 3 sitting officials who are openly pushing for higher rates. The mechanism connecting his words to gold's price runs through real yields, the gap between what bonds pay and what inflation takes away, and every sentence he chooses either widens or narrows that gap in the market's mind. If he leans hawkish, some analysts see gold pulling back somewhere in the range of $80 to $150, testing levels near $4,400, a short-term setback rather than a broken long-term case. If he stays neutral, gold likely holds close to where it sits now, and all the real tension shifts toward the September Fed meeting, with the biggest risk sitting in any unexpected hawkish surprise. If he leans dovish, which the market currently sees as the least likely path, gold could push toward the high $4,700 to $4,800 range within a couple of days, with silver moving even more sharply higher. And underneath all 3 paths sits a structural floor built from $40 trillion in federal debt, interest payments now exceeding Medicare spending, and central banks buying gold at a record pace because they're reading the same math everyone else can see if they choose to look at it. None of this is a guarantee of where prices go. Markets can surprise everyone, including the people paid to forecast them, and a single speech is still just 20 minutes against decades of accumulated economic forces. What you now have is a framework, a way to understand why this particular Friday matters more than an ordinary week, and what to actually listen for when Warsh starts speaking, rather than just watching a price move and wondering why. So here's the question I'll leave you with. If gold drops on Friday because Warsh sounds hawkish, Does that change your view of gold at all? Or does it just confirm what you already believed about why it's there in the first place? I'd genuinely like to know how you're thinking about it. So drop a comment and let me know which of the 3 scenarios you think is most likely and why. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in